Hey everyone, Colin with Zizzi Investments. We've written a couple pieces recently on the Silicon Valley Bank collapse and kind of the whole lead up to that and what ultimately led to the downfall. But I think sometimes it's just easier to see things visually. So I wanted to pull this up here. This is the U.S. Treasury yield curve. And this is what you keep reading in the media that Silicon Valley Bank really mismanaged their duration risk. And duration is just a fancy term for how sensitive is a bond's price to a movement in interest rates. And the shorter term your maturity or shorter term your bond is, the less sensitivity it's going to have to interest rate rises. So what we see here on this chart is as of a year ago, as of a month ago, and then where we're currently at as of last week. So this dark blue line, this was the Treasury yield curve a year ago. So it kind of looked as it should. Shorter term rates were below where longer term rates were. And the shorter term rates are what the Fed actually controls. So when they're talking about raising the Fed funds rates, they're talking about raising the short term borrowing rates, which affects the shorter term Treasury market here. The longer term rates, the Fed actually has very little control over that. Some through interest rate policy, but the longer term or your longer term treasuries are more controlled by what's actually going on in the overall economy. So, keep that in mind. Shorter term on the curve is what the Fed controls. Longer term is what the economy is actually controlling. So what happened to Silicon Valley Bank? Well, with all the boom in the VC markets, they were taking in tons and tons of deposits. So they swelled from like 50 billion of deposits to over 200 billion before they collapsed. So all this money came in, and you see as of last year, the short end of the curve, they were still able to earn very little interest on that money. So what they did, all these deposits flooded in, they took a big chunk of those deposits and they invested them out here in longer term treasuries and mortgage-backed securities. So duration is only an issue if you can't hold those bonds to maturity. But this is where Silicon Valley Bank really messed up and dropped the ball on their risk management, because if you're a bank, your depositors can request their money back at any time. And Silicon Valley Bank, they were a bank that was highly focused all on the same sector, which was the VC and tech and startup sector. So 90+% of their deposits were uninsured. They were all highly concentrated in this one industry. And this led to a lot of what we call idiosyncratic risk, so industry-specific risk for this particular bank. So over the last year, as the economy's weakened, inflation spiked, these tech and VC company-backed companies have really struggled because they are not profitable companies yet for the most part. So what profit or what cash flow they do make, they're largely reinvesting into the business to try to grow. So as they start burning through cash faster, they start pulling deposits out of the bank. At first, it's just a slow trickle, and Silicon Valley Bank is forced to sell these longer term bonds at a loss. So why did they have a loss? Well, because interest rates spiked, which was caused by the Fed's policy. So the Fed raised short-term interest rates over here starting in March of last year. They did the first hike. And since then, interest rates have gone from 0% to 4.5% on the short end of the curve. They haven't risen as much on the long end, but remember that long duration bonds have much more sensitivity to a rise in interest rates because of reinvestment risk. So if you had a 10-year bond that was paying 1.5% last year, new 10-year bonds are at 3.5% now. You have to heavily discount those bonds that are selling on the second market to make the yields equal out for an investor who would be buying those today. So Silicon Valley Bank, deposits starts flowing out. They're forced to sell these treasuries at a huge loss, and this creates a hole in their balance sheet. So they realize this is happening. They go to markets, to investors to try to raise capital. Well, the timing of this was just awful because at the same time, there was a large crypto-focused bank, Silvergate Capital, that had announced it was insolvent. Some of this trickled over into Silicon Valley Bank. Some of it was the VCs creating hysteria, but basically you had a run on the bank in 2 days that just completely wiped out Silicon Valley Bank. So our view was this was largely isolated to Silicon Valley Bank, But now the messaging by the VCs, the Fed, the government has basically spilled this over into the larger banking system. I think the larger banking system was well capitalized heading into this. Most banks have a much more diverse deposit base. They're not heavily focused in the tech industry and the startup industry. So yes, it's created panic. It's created spillover into the large banking industry and the economy by nature of that. But our view is that events like this have happened at varying degrees of frequency throughout history. We've been through so many different events and shocks to the system that people at the time were saying this time is different. This time it's the end of the world. We've had the Great Depression. We've had World War II. We've had the Vietnam War. We've had inflation in the 70s. We've had long-term capital management collapse. We had the savings and loan crisis. We had 9/11 and the tech bubble. We had the great financial crisis. We had COVID, where the world basically shut down. We have gotten through all of those events. So we can never guarantee what's going to happen in the future, but our best estimate is to rely on how markets reacted to those historical events. And what has happened is markets have always gotten past them. So yes, this is an uncertain, yes, this is a fearful time, but we're looking at this actually as a time of opportunity, that if you had a lot of cash sitting on the sidelines, it doesn't mean you need to go throw it all into the market right now. If we look over here, what has happened, you had a 3-month bond that was paying next to nothing last year. You can now get 4.5% on a 3-month treasury. And remember, this treasury you only need to hold for 3 months to earn that rate of return. Whereas Silicon Valley Bank messed up over here because they were holding bonds that they needed to hold for 10 or 30 years to actually achieve the stated returns on there. So this move in interest rates over here actually provides an opportunity to get a relatively safe rate of return on shorter term cash. And we had already been instructing clients on that over the past 6 to 12 months that, hey, even if you don't want to get into the stock market or riskier parts of the bond market, here's a way you can diversify some of your cash and earn a better return on it. And for younger investors then too, especially historically, anytime the market's been down 15 or 20%, it's been a great time to get started with investing. Yeah, we can't make guarantees of the futures, but at least historically, anytime the market has suffered a decline like that, the returns have been pretty good from that point when we look out 1, 3, 5, and 10 years. So that's kind of how we've been managing through this and talking to clients about it. But if you have any questions, don't hesitate to reach out, like, share, comment on the video, and we're happy to answer any of them. Thank you.